Watch this before Thursday. What just happened in silver makes no sense. Silver crashed 42% in 5 months. Then it did something the crash was never supposed to allow. It came back. Not all the way, not yet, but enough to make every model built in June look wrong. In January of this year, silver touched an all-time high near $121 an ounce. By late June, it had fallen below $56, its worst monthly decline since 2011. Analysts called it the end of the bull market. Traders who bought near the top called it a disaster. And then, in the first days of July, something happened that neither group expected. Silver ripped back above $62 in a matter of sessions, posting one of its sharpest weekly gains of the year. That is not how a dying market behaves. And by Wednesday of this week, the Federal Reserve releases the minutes from its last policy meeting, the first real window into what's happening behind closed doors since the new Fed Chair took office. If you hold silver, mine silver stocks, or are simply trying to understand where the next move goes, what happens between now and Thursday may matter more than anything that happened in the last 6 months combined. Here's what we're going to do in the next 20-some minutes. We're going to show you why silver crashed the way it did, and why almost nobody explained the real mechanism correctly. We're going to show you what's happening inside the physical market that the price chart alone cannot tell you. And by the end, you'll understand exactly why the next 72 hours carry more weight than they appear to on the surface. Most investors are watching the price. We're going to watch what's underneath it. There's a reason the mainstream financial press moved on from this story the moment the crash stopped being dramatic. Stay with me, because the story didn't end. It just went quiet. The mystery. Here is the part that makes no sense if you only look at price. Silver fell 42% from its January peak. Industrial demand for silver, used in solar panels, electric vehicles, AI-related electronics, and defense manufacturing, did not fall anywhere close to that. The Silver Institute's most recent supply data points to a structural deficit widening to roughly 46 million ounces for 2026, the 6th consecutive year the world has consumed more silver than it has mined. 6 years, not one bad year, not a blip, a pattern. So if the metal is short in the ground, and the industrial world needs more of it every year, why did the price fall harder and faster than almost any other asset in the first half of 2026? The honest answer is that two different markets are trading under the same ticker symbol. There is the paper market, futures contracts, leverage, margin requirements, speculative positioning. And there is the physical market, bars, coins, industrial buyers, vaults. In January, those two markets were, for a moment, telling the same story. By late June, they were not. That divergence is where this gets interesting, and it's where almost every explanation you've read gets it only half right. Context. To understand what happened, you have to go back to late January. Silver had already surged more than 150% over the prior year, part of a broader precious metals rally that also pushed gold above $5,600 an ounce. Then, on January 30th, the CME Group raised margin requirements on silver futures contracts. Overnight, the cost of holding a leveraged silver position jumped substantially. Traders who were fine holding silver at one margin level suddenly weren't fine holding it at a much higher one. Forced liquidations cascaded through the futures market, and silver fell roughly 30% in a single trading window, one of the largest one-day drops on record. That was the first crash. Silver bottomed near $74, then spent the following months grinding lower as a second, slower story built underneath it, a strengthening US dollar. In May, Kevin Warsh was confirmed as the new Federal Reserve Chair. Markets initially expected a dovish tilt. Warsh had, in the past, argued publicly for lower rates. But at his first policy meeting as chair, on June 17th, he did something markets did not expect. He stripped out forward guidance entirely, skipped the customary dot plot, and told reporters plainly that the Fed had, in his words, missed on inflation for years. The dollar strengthened. Rate hike odds for the fall rose sharply, and silver, which trades partly as a monetary asset and partly as an industrial commodity, took the hit on both fronts at once. By the end of June, it had fallen to the low 50s, its steepest monthly decline in over a decade. Here's where most coverage of this stops. Crash explained, story over. But that's only half the story. The hidden layer. While retail sentiment was capitulating, something else was quietly being built on the other side of the world. On May 22nd, an exchange most retail investors have never heard of, ABAX Exchange, based in Singapore, launched something the silver market has never really had, a physically deliverable 1,000 troy ounce, 4/9 purity silver futures contract, settled into vaults in Singapore, including Brink's facilities. Within its first trading sessions, participation came in from firms across Singapore, Thailand, and India. This matters more than it sounds like it should. For decades, the global reference price for silver has been set largely through COMEX in New York and the London markets, both dominated by paper contracts that are, in the overwhelming majority of cases, never settled with actual metal. Most COMEX silver futures are cash settled or rolled forward. The contract exists. The metal underneath it, in most cases, never physically moves. What institutions do with silver and what the ticker implies about silver have quietly diverged for years. A physically deliverable Asian benchmark changes the incentive structure. It gives industrial buyers in the region, solar manufacturers, electronics producers, a pricing mechanism tied directly to metal they can actually take delivery of, rather than a derivative several layers removed from the physical world. The Silver Institute's own leadership called it a step toward closing a long-standing gap in price discovery for Asia's industrial silver users, which raises the question almost nobody in the mainstream financial press has asked out loud. If industrial buyers increasingly have reason to demand physical delivery rather than trade paper exposure, what happens to a paper market that has spent years pricing silver as though the metal underneath it is more abundant and more available on demand than it actually is? We'll come back to that. But first, you need to understand what happened at Sintra, because it's the single biggest reason silver is back above $62 instead of still falling. Escalation. On July 1st, Kevin Warsh made his first appearance on the global stage as Fed Chair, sharing a panel with ECB President Christine Lagarde, Bank of England Governor Andrew Bailey, and Bank of Canada Governor Tiff Macklem at the European Central Bank's annual forum in Sintra, Portugal. Markets expected more of the hawkish discipline from his June debut. Instead, Warsh said something subtly different. He acknowledged that inflation risks, in his words, had come down in recent weeks, even while repeating that prices remain too high and that returning to the Fed's 2% target is still the job. He described labour market conditions as stable and said the growth outlook may have improved. That's not a dovish pivot. But it is not the same Warsh who opened his June press conference by declaring the Fed had missed on inflation for 5 years. 3 days before Sintra, ADP's private payroll data had already come in soft. Then, the same week, the official June jobs report landed. Non-farm payrolls rose by just 57,000, less than half of what economists had forecast, with downward revisions to both April and May. According to the CME FedWatch tool, the market-implied odds of a rate hike this cycle fell from around 66% to roughly 50% in the span of days. Here is the mechanism, plainly. A softer labor market and a Fed chair whose tone has visibly cooled both reduce the odds of aggressive tightening. Lower expected rates reduce the opportunity cost of holding a non-yielding asset like silver. The dollar weakened. Silver, which had been sliding for months on the assumption of a hawkish Fed and a strengthening dollar, caught its sharpest weekly gain of the year. And this is where most analysts stop. Fed tone shifts, dollar weakens, metals rally, story complete. We're not going to stop here, because there's a second force running underneath this recovery that has almost nothing to do with Kevin Warsh. Historical parallel. Now, this is where the story changes completely. Everything we've covered so far was important. What comes next connects the current moment to a pattern precious metals investors have seen once before, almost exactly. In 2011, silver fell from a peak near $50 to roughly $26 in a matter of weeks, one of the most violent commodity corrections in modern history. The parallels to what happened this June are not subtle. In both cases, a crowded, momentum-driven trade collided with a stronger dollar and tighter financial conditions. In both cases, the metal's underlying industrial demand story remained intact, even as speculative capital fled. And in both cases, the investors who sold into the worst of the drop were, historically, the ones who missed the following recovery. But there's a meaningful difference this time, and it's worth being precise about it, rather than assuming history repeats identically. Violent, across-the-board commodity crashes typically accompany a genuinely deteriorating economy. This time, the broader data hasn't pointed that way. US GDP growth was revised upward for the first quarter of 2026, not downward. This wasn't a 2008-style liquidity event. It was a leveraged, margin-driven unwind sitting on top of a Fed communication shock. A different animal wearing a familiar face. Sound familiar? It should, but don't mistake a familiar pattern for an identical outcome. That's the trap that catches investors who trade on pattern recognition alone, instead of asking what's actually different this time. Present-day implications. So where does that leave things right now, heading into Thursday? Silver sits near $62 an ounce as of this week, down sharply from January's all-time high, but up meaningfully from June's lows near $55. The US dollar index rose roughly 2.4% in June, one of its strongest months in about a year, and that move is now partially unwinding as rate hike expectations soften. Futures markets are pricing meaningful odds of a Fed move by autumn, though nothing close to certainty, and Warsh's own refusal to offer forward guidance means the Fed is, deliberately, not telling markets what comes next before it happens. That refusal to signal is itself a data point. A Fed that won't commit to a path is a Fed that wants markets pricing probability, not certainty, which means every incoming data release, including Wednesday's meeting minutes, carries outsized weight it wouldn't carry under a more predictable Fed. Layer the structural deficit on top of that. A sixth consecutive year of silver mine supply falling short of consumption doesn't resolve on a monetary policy timeline. Silver is mined overwhelmingly as a secondary byproduct of copper, zinc, and lead operations. Miners can't simply ramp up silver output because the silver price moved. That mismatch between a slow-moving supply side and a fast-moving monetary and sentiment-driven price is precisely the kind of setup that has historically produced silver's most violent moves in both directions. Let's look at this carefully rather than emotionally. The bullish case rests on the deficit, on a physically deliverable Asian benchmark quietly building a parallel pricing mechanism, and on a Fed whose tone has softened. The bearish case rests on a Fed that has explicitly not ruled out a hike, a dollar that could resume strengthening if the minutes read more hawkish than expected, and industrial demand from solar that is easing slightly as manufacturers use less silver per panel. Both cases are real, neither is a certainty. Future scenarios. If current conditions continue roughly as they are, a Fed in a genuine holding pattern, a labor market cooling gradually rather than collapsing, one reasonable scenario is that silver spends the second half of 2026 in a wide, volatile range, with the structural deficit providing a floor and Fed uncertainty providing the ceiling's resistance. A second scenario. If Wednesday's minutes and the broader run of data between now and Thursday read more dovish than markets currently expect, confirming that Warsh's Sintra tone reflects genuine internal consensus rather than a one-off comment, historical precedent around dollar weakening episodes suggests silver could push toward retesting the upper part of its 2026 range relatively quickly, given how thin available physical supply already is relative to industrial demand. A third, more cautious scenario. If the minutes reveal a Fed still internally divided, with a majority of officials leaning toward higher rates by year-end, the dollar could resume its June strength, and silver's current bounce could stall or reverse. Not because the deficit disappeared, but because monetary conditions in the short run can overpower even a genuine physical shortage. Markets may be signaling that we're at exactly this kind of inflection point right now, which is precisely why the days immediately ahead carry more weight than a typical week. The Smart Viewer section. While most retail investors are watching the daily price candle, wondering whether to buy the dip or wait for another leg down, the pattern underneath the price tells a more useful story. Paper markets and physical markets are slowly, quietly diverging, and a new physically backed benchmark is emerging in the one region of the world where industrial silver demand is growing fastest. That's not a story that shows up in a headline. It shows up in trading volumes on an exchange most people watching this video had never heard of 10 minutes ago. The people watching this video to the end are not the investors reacting to Friday's close. You're the ones asking why the physical market and the paper market stopped agreeing with each other, and what that disagreement tends to resolve into, historically, once it's gone on long enough. That question is worth more than any single price target anyone gives you this week. The ending. Silver crashed 42% in 5 months. Then it came back, sharply, unexpectedly. In the same week, a Fed chair known for hawkish discipline suddenly sounded less certain of his own conviction. That is not how a dying market behaves. It's how a market behaves when two competing forces, a real, physical scarcity and a monetary policy still finding its footing, are pulling against each other in real time, and nobody, including the people setting policy, is entirely sure which one wins first. Wednesday brings the minutes, Thursday brings the market's answer to them. Whatever that answer is, it won't be the end of this story. It'll just be the next chapter in a divergence that started building the moment a stronger dollar met a shrinking pile of physical metal and hasn't resolved yet. This video is for informational and educational purposes only and does not constitute financial, investment, or trading advice. Precious metals markets are volatile and carry risk of loss. Past performance is not indicative of future results. Always conduct your own research and consult a licensed financial advisor before making investment decisions.